Good morning, everyone, and welcome to this week's edition of Bond Vigilantes TV. Today, I'm delighted to be joined by Stefan Isaacs, who is a fund manager on our investment grade and high yield funds. Good morning, Stefan.
Morning, Pierre.
And I wanted to ask Stefan a few questions around the European bond markets, as they have been in the spotlight of recently. And of course, we had the ECB meeting last week. So, Stefan, starting with the ECB meeting, a lot of people say it was, on the whole, non-eventful. What were the key highlights for you?
Yeah, I think that's right. I think they tried to paint a picture of steady as she goes, whilst acknowledging there had been some weakness in the data recently, but an attempt to reassure markets that they're still on the course that they've laid out. For me, it was largely an unchanged message, one that the ECB wants to remain very accommodative, and they want to really take their time and sort of inch towards the exit rather than move too quickly and risk spooking markets, because they recognise that the last thing they want to do is cause a tightening of conditions and then have to ease policy where, frankly, at the moment there is practically no room to do that.
So they'll continue to be reactive rather than proactive.
I think that's right, yes.
Okay. And in terms of, you mentioned it, the weaker economic data, and Mario Draghi actually gave a long list during the press conference of data that had actually been weaker than he expected. Do you think it's the beginning of something more serious or just transitory, as the ECB was mentioning?
I think it's probably fair to recognise that the data had been outstanding for quite a while, and growth had been growing well above target, so not surprising to see it come off the boil a little bit. But at the same time, whilst there's still quite a large output gap that needs to be closed, that is something that needs to be watched closely. I think that for any open economy like the eurozone, concerns about trade wars and geopolitics is going to weigh on confidence and potentially activity. Well. And you're right. And the strengthening of the currency as well does act as something of a sort of tightening of conditions. So I think they're right to be very aware of it and right to signal to the market that if anything, they've stepped back very marginally from what was perhaps a slightly more hawkish bias in the previous month.
Okay. So moving on to markets now, essentially, the big talk last week was, of course, US Treasuries going over 3% for the first time in many years. But bond yields have been fairly resilient over the past year, and to a point where a lot of investors have been surprised by how Treasuries and bonds have diverged so much over the past years, and we show a chart to this effect. What is your outlook for bonds? Is that gap going to close, or is it going to continue to increase?
Well, I think it's easy to explain ex post the differential between the two. Clearly, the US economy is in a different stage of its cycle. I think we've seen something like 6 rate hikes from the Fed so far in this cycle. We'll probably see another 3 this year, and we're not going to see anything from the ECB this year. So we're going to get to a point where we've had 10 rate hikes from the Fed, one would have thought, and nothing from the ECB, which should obviously explain quite a large of the differential between the two. The real question is how does the inflation question play out in the eurozone over the coming months? If we do start to see further firming of prices in the eurozone, then that will enable the ECB to start to tighten policy, and you would think that would mean higher bond yields in Europe, and maybe that gap starts to close. But at the same time, we're already seeing that firming of data and firming of inflation in the US, which means that the two could stay quite disconnected for some time. So I think really what's absolutely key is watch the inflation data coming out of the US market, watch the inflation data coming out of the eurozone, and that will dictate central banks and the behavior of bond markets. Okay,
great. My final question is on the credit markets, essentially, which I know is your specialty. Peripheral European government bonds have had a really strong run, but after January, investment grade European credit essentially hasn't been as strong. Has that raised any opportunities in your investment universe?
Yeah, that's right. So if you look at the periphery, look at, for example, take a Spanish or an Italian government bond and look at how those spreads have narrowed versus, for example, Germany, you can see that they have been the big outperformers. And I guess, a continued relatively easy central bank in Europe has helped to narrow those spreads. Away from that, you've had some disconnects in credit markets. So European high yield has done relatively poorly this year, where investment grade has done relatively well. And it's been almost the mirror image in the US, where the US high yield market has performed quite well, but the US investment grade market has underperformed. So there have been opportunities between the different markets, and there continues to be opportunities. But in aggregate, one would observe that the credit spreads are still relatively tight. We've clearly had several years of spreads tightening on the back of, frankly, accommodative central banks globally. And until we see some kind of catalyst to push spreads wider, I think that we have to be a little bit careful about where we take our credit risk. But on the other hand, one would recognise that central banks are unlikely to, as we've discussed, to move too quickly. Default rates remain extremely low by historical standards, and companies, by and large, look in good shape. So at this stage in the cycle, one would expect spreads would be relatively compressed. You have to ask yourself, what is the catalyst for them to move wider from here? And whilst there might not be too many, you have to then pick and choose your areas where you can find some value.
Okay, great. Stefan, thank you very much for being here.
Cheers. Thanks, Pierre.
In terms of what to watch out for this week, we have the inflation numbers coming out of Germany and Italy today, as well as the US core PCE deflator in the US. On Wednesday, we have Euro area GDP for the first quarter of 2018, as well as the all-important FOMC meeting on Wednesday evening. And then finally on Friday we have again the employment report and the non-farm payrolls coming out of the US. In addition to that, we also have a large wave of companies reporting from all around the world. Over 1/3 of the S&P 500 will be reporting this week, and over 60 companies in the Stocks 600. So expect a busy week. Have a great week, everyone, and thank you for watching.